To make it, we have now covered technical analysis. Now, the second type of most used analysis is fundamental analysis because we have two main trading schools. One is technical, one is fundamental, and the third category we have, which is used as a sustainable category, is called market settlement. So now we start fundamental analysis. What is fundamental analysis? So basically, as we discussed earlier, it calculates economic, vertical, and social factors. It understands the influence they have. This tells us why the price movement happened if it did. So what is your fundamental data that we need to keep an eye on, which will help us decide whether the price will go up or down, defining the trend for us? We have four things in that. We need to focus on them the most. First is the interest rate. What is the interest rate? The interest rate is the return that a country's central bank gives to those who buy their bonds. When buying these bonds and yields, or even in pure currency nowadays, we get profit and return. Now, who decides this? The central bank decides this. Okay, now if the interest rate of a currency is high, what will the currency be? It will be strong. If the interest rate is low, the currency will be weak. Provided that if the interest rate is high, then the economy should also be strong. If the economy is weak and the interest rate, if it is strong, then the currency will not be strong. Then comes the second point. We have inflation. What is inflation? It is the meter by which we measure or gauge inflation or price rise. Alright, now what is the relation of inflation? Because if inflation is high, the interest rate will be high. Now the interest rate will be high because employment will be high. What does employment data do? Employment data reflect the conditions of the labor market. The situation tells how many jobs people have, how much salary they have, whether labor is less and demand is more, whether labor is more and its demand is less. All these things are found out. Now, where is the demand and supply of labor found out from? This is found out from GDP, from domestic production. It tells you the overall output of the entire country. So basically what happens? If your GDP is good, your employment will be fast. When your employment is fast, people will have more money. They will buy more things. When people buy more things, inflation will increase. Because the supply-demand formula is such that supply is the same but demand has increased. So what will happen? There will be inflation. When there is inflation, what will the central bank do? The central bank will increase the interest rate. What difference will increasing the interest rate make? The difference will be that banks will reduce lending in the market and people will also take fewer loans. Why? When they have to pay more interest on the loan, they were giving it at 1% with a smile. The central bank increased the interest rate. Now they have to pay 10%. So what will they do? They will reduce taking loans. When they reduce taking loans from the bank, automatically business obviously businesses also take loans. If business loans are reduced, what will happen? The economy will slow down, the market will become sluggish, employment will also decrease. When employment decreases, the demand for things will automatically decrease. When demand decreases, inflation will also come down. So what is the purpose of the central bank? Their aim is to keep inflation under control. Now discussed according to the interest rate. Interest rates matter because they attack investment at higher interest rates. They create demand for currency. Two interest rates make the currency weak and its appeal ends. So the currency becomes weak. Need to keep an eye on the interest rate differential. One currency has a high interest rate and one has a very low rate. So what will happen? The currency with the high interest rate will be strong as compared to the weak one. Then the biggest thing is that if the currency moves when the interest rate changes, then the market also moves when their expectations change. Without fundamental analysis, we need to understand one point. What do all the people who do fundamental analysis do? They move on future expectations. That is, if they have this expectation, they analyze the data, look at the current situation, and saw that due to those current conditions, what conditions will arise in the future? What situation will be created in the future? What will they do because of that situation? If the situation is good, they will start buying that currency. If there are bad conditions or such conditions, it comes in between due to interest rate expectations. Traders expect that going forward, the central bank will continue to increase its interest rate and will increase it more. Two currencies will start becoming strong.
That means the interest rate has not increased yet. But speculation, we read. 90% of the traders are speculators, so speculation will start. Now, what is the future expectation? That the currency will become strong, so the currency will start becoming strong.
Alright, so because of this, they trade on expectations. Now, there are different ways to read these expectations. The Federal Reserve shows its plot, then the CBO and all these central banks give their projections. Where will our next interest rates go in the future? So the central bank we discussed uses monetary policy to influence growth, as we have already discussed. There will be some growth. What growth do they want? They want optimum growth, not too much, not too little. They want growth such that inflation is at the 2% target. If inflation is higher, they dampen growth, bring it down so that inflation also comes down. Alright, and now we have two types of policy. One is interaction policy and the other is expansion policy. Interaction policy is to slow growth by increasing interest rates. As we discussed, if interest rates are high, there will be no liquidity, meaning no money in the market. So there will be less money. People will stop borrowing money from banks, so liquidity will decrease. With less money in the market, the demand for goods will decrease. So inflation will automatically decrease. USA. It is called contractionary policy, expansionary policy, or like our Japan, it is the champion of expansionary policy. What does it do? It stimulates its growth by keeping its rate low. It will keep its rate as low as possible so that growth is maximized, so that people take more and more money, do more and more business. There is more and more movement in the market, so more and more work happens. Because if there is business, there will be employment. If there is employment, people will have money and they will spend. So now the central bank. The central bank has two terms. One is hawkish terms and the other is dovish terms. Okay, what are hawkish terms? They favor interest rates to fight inflation. And what do dovish terms say? Those who are dovish favor economic growth and employment over inflation. They say that if inflation increases a little, it's okay as long as growth and employment are not affected. Those who are hawkish say, we don't give a shit about what happens. We need to bring inflation down first. All the speakers of the central bank, all the central banks, we have the ECB, the European Central Bank, we have the BOE, the Bank of England, then we have the SNB, the famous RMBA of the Swiss National Bank, Royal National Bank of Australia, then we have the RBNGD. The Royal National Bank of New Zealand is the famous BOK. The Bank of Canada has the BOC, the Bank of Japan. Last but not least, the main mover, the main game maker, we have the Federal Reserve of the United States. There is the FOMC. So this central bank has its speakers, its chairman, its decision makers. We will discuss in detail later. So we categorize them as hawkish or dovish. On what basis? Who wants to bring down inflation? How will we differentiate whose priority is to fight inflation and whose priority is economic growth? Strong fundamentals, strong economic growth, strong trade. So the country with good conditions, the country with a good economy, its currency will also be strong. Then there is another thing, which is capital flows, trade deficit. The one thing that affects the currency a lot, if more money is coming into a country and less money is going out, what do we call it? Capital flow. So if more money is coming into the country, the currency will be strong. If more money is going out and less is coming in, then the country's currency will be weak. So trade surplus is a very important point. Countries with good trade surpluses will have strong currencies. Those with weak surpluses will have weak currencies. We will discuss this further. The dollar is an exception in all this. Why is that? We will discuss that further as well. And government stability, most of all in countries where the geopolitical situation, economic situation, and political situation are stable, what happens? People gain trust. When people are confident, they invest in that country. Obviously, as we discussed, more money is coming into a country compared to the money going out of that country. So if people trust that country,